Good evening and welcome to our second quarter stock market update call at Great Lakes Private Wealth. This is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. The call tonight is being recorded and will be on our website, greatlakesprivatewealth.com, on Wednesday morning. Now let's get into what happened in the market in the second quarter and what we're going to see going forward. Pat Patin will give us some data, and then I'll update you with my outlook on the markets. Pat?
Thank you, Dan. This is Pat Patin, partner and portfolio manager of Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we will be providing is from sources we believe to be reliable, assurance that the information is accurate or complete. Starting off with some key stats for our call, the S&P 500 year-to-date is up 19.2%. The Dow Jones Industrial Average is up 7.5%. The NASDAQ Composite is up 36.5%. International stocks represented by the EFA Index are up 13%. Gold is up 6.4%. And bonds represented by the Bloomberg Aggregate Bond Index are up 2%. The key title for our call might be The Magnificent Seven. Not the 1960s Western film, but the top 7 companies powering much of the stock market's returns year to date. These Magnificent Seven, Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Facebook, have gained over $4 trillion in value this year to a combined market capitalization of $11 trillion. That equals about half the U.S. GDP and about 3 times the GDP of Germany. The Magnificent Seven have contributed 14 of the 19% gain in the S&P 500 this year. These companies all play a key role in the development and application of AI, but it is worth remembering that the key driver of their earnings is still not artificial intelligence. The top 10 holdings in the S&P 500 now make up over 30% of the index, the highest concentration we've seen with data going back to 1980. For those of you watching on your computer or your phone, we've provided a chart on this. For those who cannot access them right now, they will be available tomorrow morning on our website. You could say that with such large weightings in our stock market, one of the interesting parts of modern finance is how everyone's retirement is dependent on Apple continually generating growing earnings by selling you another iPhone. The move in these AI and technology names this year has brought out some parallels to the internet.com bubble of the early 2000s. One of the main bullish arguments in support of this market is that artificial intelligence is creating a revolution, much like the internet did in 1999-2000. While the impact of AI could be immense, it is unlikely to have the same sort of economic impact that the internet had. A primary difference between what happened during the internet bubble and this so-called AI bubble is today's move is very narrow and concentrated in only a few large names. There are just a handful of smaller cap AI plays currently. In 1999-2000, there were hundreds of smaller stocks that were making huge moves and far surpassed many of the leading big caps. There was a tremendous amount of speculation based on things like page views. There is no similar real action like that in the AI area, at least as of right now. Just as an example, in December 31st, 1999, Microsoft was at $58.37 per share. It did not surpass that price until October 31st, 2016, at $59.92. That is almost 17 years. Another name that was a central company to the internet was Cisco Systems. On December 31st, 1999, that stock was selling for $53.56 a share, and today that stock is below that and is at $52.66 a share. Remember, that is only the stock price. It does not include any dividends these stocks have paid. I just want to highlight that we don't want to get too carried away with the hype of the day. Companies are putting AI towards the top of their list, with the average mention of AI on analyst calls skyrocketing this quarter. This potential breakthrough excites some and worries others. However, there are some key areas in medical research that are gaining positive traction with the benefit of artificial intelligence. I want to share one example of the power of AI. Proteins are the building blocks of life, but only a tiny fraction were understood because 3D mapping of just one protein could take years. It normally takes a PhD candidate 5 years to 3D map a protein. Google's DeepMind AI app 3D mapped all 200 million known proteins in 7 weeks, shortcutting about 1 billion years of PhD level research without prior technology like this. These new maps have already begun to be used to design a malaria vaccine and enzymes that eat plastic. They even have the potential to soon cure all human diseases. There are also breakthroughs occurring without the help of AI. It has been over 100 years since researchers discovered that some materials can conduct electricity perfectly. Recently, a room temperature superconductor called LK99 was developed that could be transformative for science and technology. While early and unproven, some scientists say that it would make it much easier to create fusion energy, dramatically improve battery technology, allow motors to be more efficient, and even make things like magnetic levitating trains and quantum computers possible. It sounds like science fiction, and it is still very early days, but the investment boom from the discovery of such a material, especially since it is made from easy-to-find materials like lead, copper, and phosphate, could be enormous, maybe even unprecedented. We'll continue to follow these developments, the potential investment opportunities that may present themselves, and their impact on the economy. These things are in the future, but let's get back to what's happening today. The markets have been able to climb a wall of worry over the last year. It started with concerns over increasing inflation, then rate hikes, an inverted yield curve, quantitative tightening, and a banking crisis. The market has been resilient through all this, despite the many cross currents in the economy. Consumers are still spending despite reduced personal savings rates to 4.6%, below the decades-long average of 8.9%. The economy and markets have been more resilient than many expected. And with that, I'll turn the call over to Dan for his stock market outlook.
Thank you, Pat, and good evening, everyone. I'm suffering with a head cold, so bear with me, but I think you'll be able to hear me loud and clear. The second quarter of 2023, as measured by the S&P 500, was a fairly strong quarter. The theme from the first quarter of a few stocks going up and carrying all the weight of the market continued into and through the second quarter. As I said on the last call, the very best stocks of 2023 were many of the worst stocks of the previous year in 2022, and this has continued. As Pat mentioned, the bifurcation in the market continued with the Magnificent Seven dominating the market. I've got a chart again for those that can see it, and you'll see it tomorrow on the website, showing these 7 names and how much they've outperformed the rest of the market. These 7 names in the S&P 500 have contributed over 73% of the index's total return. If those 7 stocks were not in the S&P 500, the index would be up only 5.3%. That's right, only a little more than 5%. That means the other 493 stocks were up barely 5% year to date. The S&P 500 is a cap-weighted index, and that means that even though there are 500 stocks in the index, the bigger stocks play a bigger role in the ups and downs in the index's value. Conversely, the smaller names play a much smaller part in the index. It is different with the equal-weighted index that measures all 500 stocks equally, not giving any stock more or less value than the next stock. This equal-weighted index total return is up only 10.4% year to date. This is the second largest spread ever between the two indexes, and this data is from Bloomberg Intelligence. It highlights a disparity that does not happen very often. Historically, when a few names dominate the markets, it's not a great sign for the market in the coming months. Clearly, based on how the Magnificent Seven are doing, you would assume that the economy is going gangbusters. Many of the economic reports are showing weakness and are in conflict with the performance of this Magnificent Seven stocks. On my call last quarter, I spoke about the dividend yield of the S&P 500, and I have that on the screen now. When the market was at its high in the year 2000, the dividend yield was 1.1%. That was the lowest ever. If you remember the year 2000, that was the peak of the dot-com bubble stocks. Stocks sold off dramatically after that. As a comparison to that, the lows in March of 2009, the dividend yield on the S&P was 3.6%. Another comparison is October 2011, after the U.S. debt rating got downgraded to AA+ from AAA status. The dividend yield then was 2.12%. More recently, the yield at the lows in the stock market during COVID pandemic in March of 2020 was 2.25%. On our call in May, the dividend yield on the S&P was 1.65, and today the yield is 1.49. Historically, when the yield on stocks is high, that means stocks are generally a better value. When yields are low historically, that means they're overvalued. Today, when we compare the dividend yield versus 2009 or 2020 or even October of 2011, we're not at levels where we historically see prices near the low. Of course, this is just one signpost we're watching. What's different today is the yield on the 10-year Treasury. It's at 4%. The Federal Reserve just last Wednesday raised rates again, and rates are now at the highest level in over 22 years. And it appears there's no chance of rates falling anytime soon. Another interesting fact is that through last Wednesday, the Dow Jones Industrial had been up 13 days in a row. The last time that happened was 1987. The Magnificent Seven have done very well this year and are clearly has helped the S&P 500 index do very well. We all know, though, that the market's not made up of just 7 stocks. It's made up of thousands of stocks representing all the different sectors of the economy. Let's compare some key metrics and indicators and how they compare to where they are today versus last July. When we look back a year ago, the number of negative indicators far outweighed the positive indicators. That is not the case today. Today, the number of positive indicators equals the negatives. So although the index is strong, the indicators are currently 50% positive, 50% negative. In a very strong bull market, you would expect more positive indicators than negative. One of the indicators that is showing very extreme readings is investor sentiment. This key indicator has been holding us back from getting fully invested at this time, and I'll talk about that key investor sentiment in just a few minutes. What are some of the positives? We are 9 months past the low of October. Breadth, the number of stocks that are rising versus falling every day, has been improving. Inflation has been easing. Job growth has stayed very positive. And of course, there's a lot of excitement over AI, artificial intelligence. The infrastructure bill that was signed in March has been a positive for the construction industry and the overall economy. There seems to be road construction everywhere you drive, and it doesn't matter what state you're in. Despite much higher interest rates, home builders are doing very well. This has to do with the shortage of housing. Now for some of the negatives. The Federal Reserve has raised interest rates by 0.25% last week to a 22-year high compared to January 2001 at 5.5%. This is now the 11th rate hike since just March of 2022. They are very hawkish, which means they are not in the mood to lower interest rates anytime soon. The yield curve is the most inverted we have seen it since 1980. Again, I put a chart up of that showing you the inversion that we're currently experiencing. And an inverted yield curve is where short-term rates are higher than long-term rates. As an example, today, the 3-month Treasury bill is paying 5.5%, and the 10-year Treasury is at 4%. As you can see from the chart, for those that can see it, it shows the yield curve inversion over the last 40 years. If the Federal Reserve is trying to slow down the economy, what they do is they raise interest rates, making it more expensive to borrow money. You will know that the Federal Reserve is not as restrictive if you see 3-month T-bill rates go below the 10-year Treasury yield. Why do interest rates matter so much? Because our economy, for the most part, is driven by having money available to borrow to buy a home, buy a business, buy or lease a car, and just using your credit card to buy goods. As an example, the average car payment in 2015 was $490 a month. Today, it is $735. If capital is restricted, it will at a minimum slow the economy down and may cause a recession. Given the low interest rates of the last 10 years, many businesses borrowed money at these very low rates. Now that rates have gone up so much and quickly, companies that are having to refinance are under pressure. With rates so low, many businesses that when interest rates were so low, they took on a lot of debt. Unfortunately, many of these businesses financed those loans for 3 to 5 years at interest rates as low as 2 to 3%. As these loans come due, companies are renewing loans today at interest rates that are much higher than when they originally financed these loans. They're now being forced to pay interest rates as high as 6 to 8% or even higher on debt. If you borrowed $1 billion at 3% and you now are forced to pay 8%, that's an increase in expenses of $50 million of additional interest. This is how a company can get upside down very quickly, having debt and at the same time having interest rates go up. Another negative we're seeing is that manufacturing indexes have been weakening. Just today, I believe the manufacturing PMI was down to 46 from below 50, which shows a contraction in the economy. A negative that some news sources are mentioning and others are not even bringing up is credit concerns as it relates to commercial real estate market. With lower occupancies and higher interest rates on property loans, this is causing a problem. As an example, Starwood Capital Group just defaulted per Fortune magazine on a $212 million note on Tower Place 100. This is a 29-story office building in the Atlanta Buckhead district. The delinquency rate on offices in June of this year rose to 4.5% from 1.7% a year earlier. Tower Place was 62% leased at the end of 2022 versus 87% leased in 2018. Because of the lower occupancy rates and higher interest rates, many large corporate landlords are just letting the loans default and go back to the banks. The economics of owning a building and financing it just don't make the same economic sense. This has been happening more and more as of late. The issue concerning commercial property is potentially a very large problem, and no one knows how it will all play out. The question is, how will it affect the economy, and especially smaller banks, since they have 80% of the loans on commercial real estate? The FDIC and Goldman Sachs Global Research found that small and medium banks account for 50% of U.S. commercial and industrial lending, 60% of residential real estate lending, and 80% of commercial real estate lending. One of the factors that saved the stock market this year was when the FDIC and Federal Reserve bailed out the three banks that failed in March. The bailout helped any depositor who had more money in the bank than the $250,000 of FDIC coverage. It also saved many other banks that would have probably also had issues if the Federal Reserve and the FDIC had not stepped in. The problem this creates for the future is what happens the next time banks get into a similar situation. Does the Federal Reserve and the FDIC just bail out any bank that has a problem? What is the point of FDIC insurance if everyone thinks you can never lose money no matter how high the insurance protection is? It also allowed banks to take on more risk than they otherwise might have. In short, I believe the government avoided a big short-term run on the banks by bailing out the banks, but it sent the investment markets a very negative signal that the government will always bail us out. We avoided this crisis for the time being, but I think it will have unintended negative consequences further out, and we can only speculate what it means in the long term for our investments. I'll leave it at that. Let's talk about the most important item other than interest rates, and that is inflation. Inflation has been falling for 12 months in a row. Last month's CPI was 0.2% in June, for a 12-month annualized inflation rate of 3%. The lower inflation rate has led many to believe that the Federal Reserve has accomplished its goal of lowering inflation and has gotten it under control. Once inflation is under control, this will allow the Federal Reserve to lower interest rates, and this will allow the U.S. economy to experience a soft landing. Many Federal Reserve governors, though, still believe a soft landing is possible. Their track record has been spotty at best. I want to share some of the Federal Reserve's comments from the last 2 years to show you how poorly they are at predicting what the economy is going to do. In March of 2020, they said inflation won't be a problem. In January of 2021, they said inflation will be transitory. In September of 21, they said interest rates won't rise until 2024. In January of 2022, they said a recession is needed to lower inflation. In December of 2022, disinflation has begun. February of 2023, they said a soft landing is possible. In March of this year, they said the banking system is stable. And last week, the Fed staff said they no longer expect a recession. The Federal Reserve has some of the smartest economists and statisticians available, so I bring this up to give you an idea of how difficult it is to predict the direction of the economy. July's inflation report will be out August 10th. Let's take a look at what is happening to some key commodities in the month of July. I don't know if you've noticed, gasoline is up 21%. Oil up 17%, copper 5.6%, silver 8.2%, wheat 4%, corn 3%. And again, these are just 1 month numbers. Now let's look at wage inflation from the Detroit Free Press. It stated United Airlines pilots agreed to a 40% pay increase for the next 4 years. Per USA Today, the UPS workers will receive a pay increase of 48% over the next 5 years. We still have the UAW contracts to be settled sometime this year. So based on wages and commodities, we may not have seen the end to inflation just yet. I believe this is why the Federal Reserve has continued to say interest rates can still go higher than where they are today. The real question is, how much higher can interest rates go up before the markets start to pay attention to this. Last week, when the Federal Reserve raised its rates, it did not seem to bother the stock market at all. And we say it doesn't matter until it does. Right now, the market does not seem to be too worried about interest rates. I think that is a huge mistake. We will begin to look very closely again at investing in gold. I believe that if inflation does start to increase again, gold will break out to new all-time highs and will go over $2,000 an ounce. It has hit a high 3 times near $2,080 an ounce. We call that a triple top in technical terms. If that top is broken, you could see a big bounce in gold, especially if inflation starts picking up again. So I will be watching that very closely. One of the reasons the market, I believe, has been so strong is because of all the money the government's been spending due to the so-called Inflation Reduction Act. In that bill, the government allocated $500 billion in new spending and tax breaks that aim to boost clean energy, reduce healthcare costs, and increase tax revenues. This has kept the economy stronger than it would have been otherwise. Many of the government's own statistics, though, are saying that we are slowing down and on the verge of a recession. Most long-term economists cannot figure out why it hasn't happened already, and I would argue that all of the government spending has kept the economy from falling into recession. And this is even though we've had such large increase in interest rates. That, again, is just my opinion. With interest rates the highest in 20 years, the stock market has gone up without any hiccup whatsoever, and the economy is appearing to slow. The other reason I believe that it's held up so well is that there's still money from COVID floating around. In summary, the economy is awash in money, and it makes it very difficult to have a recession bottom line. Before I close, I want to talk about the stock market sentiment, since I usually talk about it on every call. Right now, we put up the Fear and Greed Index statistic from CNN, and currently it is at 77. This is a reading of extreme greed. Our indicator of market sentiment from Ned Davis today is overbought at 74.4. Historically, that data goes back to 1994, almost 30 years of data. Whenever this indicator is over 62.2, the S&P drops at an annualized rate of 6%. When it has a reading below 41%, the market advances at an annualized rate of 26. Today, both indicators tell us the market is overbought. Investors have become very positive in the stock market. Investor sentiment is the highest in over 5 years. That is not an ideal time to invest more money in the stock market. Additionally, we are entering a very weak seasonal period of the year, August through October. Since 1945, the S&P 500 index has gained an average of 6.7% between November and April, compared to the average gain of only 2% between May and October. This data comes from the Center for Financial Research and Analytics. Historically, the fall has presented a good time to allocate funds to the stock market. We usually get oversold in September or October. Last year, on October 12th, is when the market bottomed out. It rarely pays to chase stocks and will wait for some weakness before allocating more money to the stock market. Another stat from a professor at the University of Michigan, Najat Sayem, he's been tracking corporate insider buying and selling habits over a long period of time. He recently found that net buying by corporate insiders, or their confidence in their companies, is the lowest in over 10 years. Again, that's not a sign of a lot of confidence at the present time. Before I close, I want to mention a couple of items to ponder. As interest rates rise, the federal government's borrowing cost on its $32 $8.4 trillion in debt will also increase. According to the Committee for Responsible Federal Budget, with deficits continuing to grow over time, interest on the federal debt will eventually become the largest part of the federal budget. Net interest will surpass defense spending by 2028 and pass Medicare by 2044 and Social Security spending by 2050, becoming the largest single line item in the budget. By 2053, net interest will consume 7.2% of GDP, or nearly 40% of federal revenues. In May of this year, the Treasury estimated it would borrow in the third quarter of this year $726 billion. Yesterday, they increased that number by $274 billion to over $1 trillion of borrowing in this quarter. Again, that's only a 37% miscalculation, just a $274 billion mistake. Again, that's my form of sarcasm. If the government borrows that much, it will force interest rates to go even higher. And again, I bring this up as something to think about. Now for my outlook for the balance of 2023. I think interest rates will stay high for the rest of the year and may even go higher. If we get a negative inflation print in August or September that is much higher than expected, that could be the trigger for a real stock market sell-off. Why? Because it will signal to the market that the Federal Reserve will need to raise interest rates even higher than previously expected. If inflation does continue to moderate, then I expect interest rates will stay about the same. I've mentioned on past calls that we typically get an average intra-year decline of 14% with 3 sell-offs of at least 7% during the year. We've not had even one this year. So we are overdue for a sell-off at some point. If we experience a sell-off and the indicators continue to improve further, we will take a constructive view of that and add funds to the market on weakness. We will, of course, monitor it very closely. At this time, we're keeping more cash on hand in our portfolios to take advantage of any stock market weakness. We plan on allocating our cash into the market at lower prices. The nice thing, though, today is we're getting paid on our money market accounts at an interest rate over 5%. So we can be more patient and wait to invest the excess cash when we feel it's the best time. I know when we see the market going up or we hear the talking heads tell us how the market is doing, we all want to get invested. It's hard resisting the temptation of chasing and putting money to work at the top of the market. I've been doing this a long time and I realize it more than most. A couple of other factors that may affect the markets over the next 12 to 18 months, of course, are the presidential election outcome and all of its fanfare, the continuing Russia-Ukraine conflict, China's weakening economy, and their military interaction as it relates to Taiwan, but most importantly, the direction of inflation. If the economy starts to weaken, that will take the pressure off interest rates and will be a positive for the stock market. To use an analogy of Goldilocks and the Three Bears, you have to have just the right combination of inflation and interest rates. If the economy cools down too much, we will have bad recession and corporate earnings will get weak, causing much lower stock prices. If the economy stays too strong, then inflation picks up and the Federal Reserve has to raise interest rates even further, causing a recession at some point. So it's a very fine line between raising interest rates to slow the economy without causing a recession at the same time. This is why so many prognosticators are saying the Federal Reserve has an almost impossible job of getting this just right. These are definitely unique times for the markets for sure. Of course, we use many state-of-the-art tools to help us navigate the markets, But the good news is we have the experience and knowledge to navigate these unique times. One last note, mark your calendars. We'll be having an open house on September 26th at our new office, and I hope you can all attend. Again, thank you for listening tonight, and I look forward to our next call in October.